Thanks for joining us here on Retirement News Online, where we talk about risk management a lot, and today is no different. Risk management is an important aspect of retirement planning. It is the chief differentiator between income planning and traditional wealth management, because as retirees get older and closer to retirement, they become more vulnerable to risk. And my guest to talk about this is the lovable Zach Abraham, who practices in Silverdale, Washington, just outside of Seattle. So Zach, thanks for joining us. Talk about how risk tolerance changes in retirement.
Well, I think a lot of people know anecdotally that as we get into retirement, we begin spending assets down. And one of the tricky things that I think a lot of people don't really think about is that when we're actually relying on assets, we have a much lower tolerance to volatility because, like I said, we're spending those assets down. So historically, what we've all done and what probably a lot of the viewers are used to is as we get closer to retirement, we move more and more in things like bonds and fixed income. And the whole point is we don't want that variability because we're actually having to rely on that money. So we try to approach things from it's kind of a good summation or a summary of how we do things. And it's really from a risk management standpoint and really trying to manage that volatility without giving up upside.
So what are the other types of risk that retirees need to consider?
Well, one of the things that I don't think a lot of people talk about is sequencing risk, right? It's not just what your money makes for you, but when does it make it? And it's kind of a weird topic to talk about with people that they don't think about. But when you sit down and look, maybe we have a 30% loss in our portfolio, but when does that occur, right? If it occurs when we're 50, we're probably going to be okay, because we've got time before we retire to make it up. If it happens when we're 65, 70, that could be a problem. So sequencing risk is a big risk. Inflation risk is a risk that if we firmly believe is going to be a bigger issue going forward. Not talking about hyperinflation or anything crazy like that. But we've gone through a period of time over the last 10 years where we're concerned about deflation. And it's only natural to think that inflation is going to become an issue. Long-term care is a risk. Potential long-term care expenses and retirement medical expenses can be a big risk. So, we don't want to run around and just talk risk and scare people, but we're big believers that first and foremost, financial advisors should really be risk managers. That's really what it's all about.
One other risk that is often talked about these days is longevity risk, in that retirees are now living much longer than they used to. And some advisors now think that this longer investment horizon actually justifies taking on more risk. What's your take on that?
I think when people talk about justifying risk, I think that there's a logical leap that they're making, and I think it's really dangerous. The longer timeline and the need for more money may justify more risk, but taking more risk may be the very thing that makes that not plausible, right? You taking more risk, if you a nasty downturn that lasts for a while or whatever, that can be the very thing that makes you unable to last financially for the rest of your life. So it really is about balancing absolute risk in terms of, we know market downturns are going to come, right? Everybody might be doubting that right now because we've gone 15 straight months without a 5% correction, which is a record in the market. We've gone 13 months now without a 3% correction, which is a record in the market. The S&P's trading at a 28, 29 price to earnings multiple. These are not normal times, and so it's hard to get people to think about risk and especially risk-adjusted returns in these types of environments. But if we're going out further on the risk curve to accomplish our retirement goals, it's only a matter of time until that backs up on us. And so it really, at least the way that we look at it is we say, okay, we've got to segment this portfolio and we need to look at absolute risk, because it's only a matter, if the tent is only as good as it is until a storm comes, then the tent's going down at some point, right? So we've got to make sure that the structure, the portfolio in this case, is strong enough to withstand the eventual storm, because it really is an eventuality. It's going to happen.
Zach, thanks again.
Thank you very much, and I appreciate it.
My guest has been Zach Abraham with Bulwark Capital Management in Silverdale, Washington. Thanks for watching Retirement News Online. Bulwark.